All right, let's jump right in. Today, we're looking at a huge economic signal coming out of South Africa. We're going to break down their latest inflation report and see what it's really telling us about the country's economic health.
So here's the question we're all asking. After all the economic ups and downs we've seen globally, are we finally seeing the South African economy start to, well, cool off? Is the pressure finally easing up? Let's dig in.
Okay, let's get right to the headline number, the single most important figure in this whole report, 3.5%. You're going to want to remember that number. That was the annual consumer inflation for January 2026. And it's not just a number, it's a new low, and it's really the key to understanding everything else.
So what's the big deal with 3.5%? Well, it's a small drop from the 3.6% we saw back in December 2025, but it's a really important one. It's a clear signal that the pressure pushing prices up is continuing to ease off.
And here's why that matters so much. That 3.5% figure lands it comfortably inside the South African Reserve Bank's target range. In fact, it's getting pretty close to their ideal anchor of 3%. You know, this isn't just a random goalpost. It's a strong signal that they're achieving a stable price environment.
So what's behind this cool down? Turns out there's one clear hero in this story, and its name is fuel prices. Seriously, this one single factor had a massive impact on the entire inflation picture.
And you know what? The reason for this cooling inflation is actually surprisingly simple. It really all boils down to what you're paying at the petrol station.
Check this out. Fuel prices dropped 3.7% compared to the same time last year. I mean, that's a serious drop, and it acted like a huge anchor, pulling that main inflation number down and fighting against price increases happening elsewhere in the economy. But hey, fuel wasn't a solo act. Food prices also played a really important supporting role here. Now, food inflation was still up at 4.4%, but the key is that it held steady. And even better, prices for staples like maize meal actually got a bit better. That really helps keep that headline number in check.
Okay, but here's where things get interesting. That 3.5% number, that's what economists call headline inflation. And it's not the whole story. To really get a sense of the economy's health, you gotta look under the hood at the underlying trend.
Think about it like this. Headline inflation is kind of like your total weight on a scale. It can jump around day to day based on volatile stuff like a big meal, or in this case, food and fuel. But core inflation, which strips those things out, that's more like your underlying fitness. It shows you the real long-term trend and reveals any hidden pressures.
And get this, that core inflation number, it's 3.4%. Yeah, it actually ticked up a little bit. So what does that tell us? It means that even with all the good news on the surface, there's still some stubborn price pressure simmering underneath.
So where's that pressure coming from? Well, the report points a finger directly at one area: housing and utilities. They shot up by a pretty hefty 4.8%. So if falling fuel was our hero, these rising rent and utility bills are definitely the villain pushing things in the other direction.
All right, so let's pull back and look at the big picture. We've got this good headline number, but a stubborn core inflation. What does it all mean? Well, everybody's now looking at the central bank, wondering what they're going to do with interest rates.
And that leads us to this term you're going to hear a lot: monetary easing. It's just a fancy way of saying the central bank is making it cheaper for people and businesses to borrow money by cutting interest rates. The goal? To help get the economy humming along. And this is why that low inflation number is so crucial. Because overall inflation is under control, the South African Reserve Bank has the green light, the wiggle room, to actually think about cutting interest rates later this year without having to worry about prices spiraling out of control. Okay, let's wrap this up. What does this all mean for you? Whether you're an investor, a business owner, or just curious? Well, the market is seeing three really clear signals in this report.
So here's what the market is taking away. First, inflation is contained, right? It's under control, especially when you look at how wild things are in other parts of the world. Second, we know that fuel prices are the main thing driving this right now, which of course means things could change. And third, and this is so important, the economy is showing stability. It's cooling off, not crashing into a dangerous deflation.
And that kind of stable environment, especially with the chance of future interest rate cuts, paints a pretty positive picture. Just think about the ripple effect. Easier credit could lead to stronger consumer spending, and that could pull in a whole lot of new investment into areas like property and banking.
Which leaves us with this final, massive question. The data shows an economy that seems to have found some stable ground. The ingredients for growth look like they're falling into place. But is this stability going to translate into a real new wave of economic growth? Well, that remains the billion rand question.